In this video, traders, we're going to look at what is positive slippage and why is it so important that the broker you use passes on positive slippage to you. Stay tuned. Hey guys, very warm welcome to you. All right, positive slippage. So what is positive slippage and why is it so important? Now, if you're an active trader, it is crucial that you have a broker that will pass on positive slippage to you, because in effectively, we'll look through an example in a moment, some of the scenarios that you're probably familiar with yourself. If you're a trader, you've probably been through all these situations. But what it effectively means is that if there's a price saving to be had, you get it and they don't keep it. Now, I know many brokers out there, and I've traded with many brokers over my almost 20-year career, and definitely not everybody gives you the positive slippage. So let's go through a scenario and work out what it is and why it's important. It's not something to dwell on too much, but just find a broker that's got it, like our channel sponsor. Check them out, see if they're right for you. Link in the description below. But once you've done it and you say, okay, that's done, you don't have to worry about it continually, worry about finding the right setups, the right strategies, worry about the discipline, all the other stuff we talk about. But it's one of the things that's worth having. So let's imagine we're trading ABC. It's a stock, it's a currency pair, it's a commodity, and it's an indice, whatever it could be. It could be any of these things. And we have a pattern where we kind of think, okay, you know what, this market is about to break out to highs. We've pushed up, we've held at a high level, perhaps we've kind of got a resistance level here, and we think, you know what, we're going to go long, and it's sitting at 0.2, whatever the pre-digits are for that. Just imagine we're sitting at 0.2 and the spread happens to be 0.1 to 0.2, so you've got a 1 point spread, whatever market we're trading. There's your ticket there. And in this case, you're trading a spread bet, and so you're going long. You decide to go long £10 a point at 0.2, and that's pretty much your decision to make. And you've got the ticket up, and now you click that buy button, and let's imagine you've got a market order. You've got a market order, and a market order, just a quick reminder, guys, basically says, hey, fill me at whatever price I can get filled at. I just want to get in. So you could use a limit, and you could use a limit and say, hey, I want to wait for a specific price, but I'm prepared to sacrifice not being filled. Whereas a market order says, I'm prepared to sacrifice a bit of price. I don't really mind what price I get, but I want to get in, or I want to get out if you're exiting the trade. Same kind of thing, which is in reverse. So imagine now market's sitting there at 0.2, and you say, right, it's sitting there 0.1, 0.2 on the ticket, and I'm going to buy £10 a point because you're using a spread bet. Fine. You hit the order. What happens? Well, there's a few different scenarios that could happen. The first one is you get filled at 0.2. Now, in most situations, the market's chugging along as normal. Let's say you're midday and you're trading a relatively thick market. It's not particularly volatile that day. There's no real news flow on it. You're going to be filled at 0.2. Guys, that's just the way it is. The market's not going to be moving that much. £10 a point isn't, if you're not trading something stupidly thin. Let's say you're trading Euro USD or USD JPY or cable or anything like that. £10 a point is a drop in the ocean, and you're going to get filled straight away at 0.2. You're happy. Now, couple of different scenarios, don't always happen, but it's important because, guys, in the day, we thrive on volatility and fast market conditions, right? That's what we look for, especially as active traders. I know I really enjoy trading, and I'm a much better success trading when we have some action. So it's important to have a broker that will, help you when there's market activity. You don't want someone's going to hinder you. It's hard enough, picking the right spots and dealing with the discipline and all this kind of stuff as it is, guys. It's tricky game trading. We know this. We know it's a constant evolution, a constant improvement. So we want a broker that's on our side in that respect. So two other things can happen. One is the price then moves to 0.3. Okay, so if the price moves to 0.3 and you've got a market order, and this is just as you've hit it. So we're talking about milliseconds basically here. If you hit it and it moves to 0.3 after you've filled, then great, you're up 1 point or 1 pip on the trade. But if it moves as the order, between the time you hit it and the time the order hits the broker and comes back to you, it may move to 0.3. Now, again, you want a broker that doesn't offer a dealer intervention, has no dealing desk, which Pepperstone do, but that's by the by. The point of positive slippage is, in this case, you're going to get negative slippage. You're going to say, okay, I wanted a market order. It was 0.3 by the time the price got filled. If your settings are all set up to accept that, then you're going to get filled at 0.3, or you're not going to get filled at all. So depending on what order type you're using, etc. But that's negative slippage, and that's kind of, you can't do anything about that. That's the market, where the market works, guys. By the time you put your order in, it's the way it is. I can imagine what it's like in the pit years ago when you're ringing up and saying, hey, can I buy, 50 contracts of so-and-so? Yeah, sure. You put the phone down and the market's sitting at 0.2. And by the time it comes back, you get filled at 52 or something because you left the market order. Fortunately, technology's improved a lot since then. But anyway, you know, slippage does happen. It's the same when you get filled with a stop. You know, sometimes you're going to get filled with a stop, and because it's a quick market, by the time that order comes in, and by the way, guys, it's no different whether you're trading with a broker or whether you're trading directly in an exchange. If you're trading directly on a futures exchange, imagine you're trading on CME S&P 500. It's a bit thicker, but any kind of futures contract on an exchange, and you go in and you hit an order and the book gets swept before you hit that order, you're still going to get slippage. You're going to get a different price. So that's the way it is, and that's how the markets work. Now, what is most important is what happens with positive slippage. So that's negative slippage. The market moves against you a little bit, you get filled at a slightly worse price than you expected. That's just the market movement. There's nothing you can do about that. That's just trading. Now, positive slippage is a nice thing, because positive slippage basically means that when you put your order in at 02, the market buy at 02, the price actually moves back a little bit and you will get filled at 01. So that by the time you put that order thing expecting to get filled at 02, the price has already moved down a tick. It's now 01 offered, you get filled at 01. Great, you've got a price improvement of a tick. Now, some brokers won't pass that on to you. Some brokers will say, well, you know, this guy put his order in at 02, we'll fill him at 02, and they'll keep that pip in their pocket, which adds up when they're trading with thousands and thousands of clients. So the price moves to 01, you get filled at 02, you're reasonably happy because, you know, maybe the price then moves on your ticket back to 01, you've been filled at 02, you're probably not going to be so annoyed at it, you just think the price has moved against me. But in reality, that's almost taking it from your pocket, because in theory, obviously it does depend on when the order hits the broker. Now let's not let's differentiate between two. If it hits it and you get filled at 02, then the price ticks back to 01. That's just trading. If it hits the broker and the price is now 01, they should fill you at 01 and pass on that positive slippage to you, which Pepperstone do. They will fill you at 01 and pass on that to you. So you get your order blotter filled and says filled at 01 rather than 02. That is positive slippage. So rather than them keeping that pip, they will pass that on to you, because at the end of the day, they're just trading with their liquidity providers and they're just adding a spread or a commission on, depending on whether you're using a razor or standard account. So their model isn't to kind of sneak pips off each individual client per se. You know, they're just looking to use a traditional kind of more transparent model of, hey, we execute through liquidity providers, and for that service, we will charge you a commission or we'll charge you a spread depending on how you've got things packaged and which account you're using. So pretty transparent that way. So that's positive slippage, guys. As you can see, if you were trading once or twice a month on a slow time, you're probably never even going to experience positive slippage. But if you're an active trader, and definitely if you're a day trader or scalper, you need to have that positive slippage passed on to you, because every time you are not getting that positive slippage, if it does occur, you're basically just giving away money. And if you can imagine, if you're doing £10 a point and there's a 1 pip slippage, it might be a bit extreme, but on fast markets it can happen, especially if you're trading the indices. Something like the Dow really swinging with, you know, those 1,000 points days we've had recently. You know, if you're getting a point here and there, and you're doing 5 or 6 trades a day, £10 a point, and you're getting positive slippage on a few, you can see over a month that adds up to, you know, a reasonable amount of money that you don't really have to do anything else for. That should be in your account. So positive slippage is when you're getting a price improvement on your market order that you kind of didn't expect, and it's just a nice little extra thing to have. So I'll pass on the positive slippage to you if it should occur. Again, certain circumstances only this will occur, not during every single trade, but it's worth kind of thinking about, especially if you're a more active trader. So check them out, guys. A link in the description below. Take care, keep your risk managed, whatever you are trading. Bye-bye.